So what I want to say, I think the key to understand when there is no change in control is that what we need to remember that every time we are doing consolidation, we eliminate the investment in the subsidiary. And the purpose is when we eliminate the investment that exists at the date of acquisition, then we basically eliminate the equities of the subsidiary. We introduce NCI, and we also introduce goodwill if there are differences there and it is not 100%. So what I want us to know and understand is that now the investment as far as is concerned, or the investment in the subsidiary at the date of acquisition is eliminated in the computation of goodwill. So if there is any other investment, basically an additional investment where is already now 60, it is going to 80, and we keep repeating the pro forma consolidation journal, then we are saying, how do we now eliminate the extra investment that has been done after the date of acquisition and after the calculation of goodwill? Because remember, we do not recalculate, we do not recompute, we do not do goodwill again. Unless a control is lost, then we stop consolidation altogether. All we are doing is accounting for the extra investment or the disposal of part of the investment. So just bear in mind that we eliminate the investment in the subsidiary in full, including its fair value adjustment at the date of acquisition. So if that account moves or changes, that additional amount is not eliminated in the pro forma consolidation journal, and we shall look at it. So we are basically saying what happened. Net identifiable assets are not subject. So we are saying in subsequent disposal or acquisition, when control doesn't change, we don't revalue asset and liabilities. We don't calculate goodwill. There's no goodwill. We don't recalculate. We don't remeasure goodwill. And therefore, we are saying, what now do we do with that extra? We are basically saying that if a parent was 60%, they acquire 20%, now they become an 80% influence. We are basically saying that they are acquiring equity from the non-controlling to the parent. So they are moving from 60 to 80, whereas the NCI is now moving from 40 to 20, and vice versa. It could be the equity of the parent is 80, NCI is 20, NCI, the parent disposes of 20%, and therefore the equity of the parent is moving to 60, down from 80, and the NCI is also increasing from 20 to 40. So we need to keep those proportions in mind, and we shall look at an example. Let's look at, I will assume that we have now reached the point of acquisition and we have dealt with any step acquisition up to the date of acquisition. Now I want to assume we are at 60, we are acquiring more, or there is already control. And then now what happens after the control is attained and there is extra acquisition? So that's what we want to do. And then in the same way we do with addition is the same way we do with disposal. So let's look at this example. It's saying H Limited acquired a 60% shares in S Limited for 3,900. So 60% is control. And on 1st of July 2012, and S Limited retained earning on that date were 1,000. So we are basically saying it became a subsidiary with the first step, which is first of July 2012. All net assets of S were fairly valued at the acquisition date. So there are no fair value adjustment at the date of acquisition. H Limited acquired an additional 10% of S share on 1st of July 2018 for 1,800. And we have said we are not going to remeasure anything at the fair value. So they are now moving from an influence of 60% to a 70%. And NCI is also moving downward from a 40% to a 30%. But to acquire that extra equity of NCI, that 10% that they're acquiring from NCI is costing them 1,800. So, and NCI is always measured, it's in this case measured at the proportionate of the net asset of identifiable asset. So let's look at what the question is asking. That's a trial balance. The profit of L was evenly distributed throughout the year. So from the fact information here, we can try and calculate goodwill. So H acquired 60% for 3,009 on 1st of July. So we want to find from our calculations here. I'll copy again and we measure this. Sorry, I'm repeating the same thing, but the consolidation is about repeat. So there is no previously held case in this case. So we are saying the consideration is what we've been given for 60%. We have been told is 3,900. NCI, we don't know it as yet. Let's wait and see what NCI is there. Based on this information on the 1st of July. The acquisition date is 1st July 2012. And it is important to know. Then at that date, the retained earning were 1,000. So we can work out what the net asset was at that date, but the NCI additional. Before we reach 2018, we can determine, do the fair value, the asset were fairly valued, and we know the retained earning. Therefore, if we come to the trial balance, we know that the share capital and the retained earning at that date, there are no other profit, represent the net asset. So we know the ordinary share capital at that time was 5,000. We know the retained earning was 1,000 at the date of acquisition. We don't know the rest. We just need now to calculate what goodwill is all about. But then NCI, we know it is 0.4% of the net asset. And the net asset, we know is the value we get there. And then we can now get that value of the net asset, which is 6,000. By getting that, sorry, I don't want to cancel it. I just want to, like Excel, if I say that one, and therefore we can get what the goodwill is, which is consideration plus NCI minus the net asset at the date of acquisition. What's happening is equal to 6,300 minus 6,000, which is 300. So I hope all of us can calculate. That one is the normal way. Consideration plus NCI less the net asset at the date of acquisition. If there were fair value adjustment on that date, we are going to do it here. And what normally happens is that this consideration, which will be in the separate book, will always be eliminated. To eliminate this equity, this is the equity, which is also the net asset. Remember, equity, net asset is asset minus liability, which is also equal to equity. So we'll eliminate the equity of the subsidiary, introduce these two. So basically, we are eliminating these ones. We will eliminate, let me highlight the ones we'll eliminate. With the pro forma consolidation, those are the ones we eliminate the equity and the consideration, and then we introduce things like NCI and goodwill. Those are the things we introduce with the pro forma consolidation journal. So in the ledger, let me show the ledger. If we'll have a ledger like this, if we have a ledger, so we are basically saying when they do the investment, they'll have an investment in the books, which is 3,900. So we are basically saying the pro forma consolidation will eliminate those things. So we are saying we will credit investment in subsidiary and bring goodwill and the rest. So we'll work on the investment. I want to keep the investment account there. Probably I should Let me copy. I'll not copy it. I'll pull it a little bit. Then I can introduce other things. Then from here, there I'll say is investment, and here I'll say is goodwill for us to understand what we'll be doing. And here I'll say is NCI. These are just ledger. So ideally, basically what we are doing, and that's the ordinary share capital, and we could also deal with the equity of the subsidiary is never, the retained earning is never there as well. Is never put there. I'll also put it there. So this is the credit side, this is the debit side. So I'll say that now we have this. This is the 3,900. In the ordinary share capital, we have 5,000 there. And in the retained earning, we have 1,000 at the date of acquisition. Those are the figures. So we are saying when we do the pro forma consolidation journal, we are going to credit this 3,900. So that account is fairly zero. And I'll say, let me put some light to show the ones we'll be crediting. We are going to debit this one with 5,000 and debit this with 1,000. Put it below here so that it matches. So those are the figures we will pass, but at the same time is not just that. We are going to introduce NCI, which is 2,400. And we are also going to introduce goodwill, which is 300. That by doing that, that is what we have done. So this account will not have investment, will have goodwill, will have NCI, will not have ordinary share capital of the subsidiary, and will not have the retained earning that was in existence at the date of acquisition, plus any other reserve. So ideally, that's what this journal, when we do this journal to recognize, that's what it does. So let's go back to the question. We have seen that now the retained earning of this is 9,000, but we got the share capital, then the profit for the year. Now let's look at what happened. What has happened from the date of acquisition to the 1st of January 2018? What do you think has happened? The retained earning has grown by 8,000 because on the date of acquisition, the retained earning was 1,000. Now it is 9,000. So ideally, we are saying the retained earning of this subsidiary has now grown by another 8,000. So what we do with the 8,000 that has grown? This is profit from the date of acquisition. And we know it is a 40% acquisition. They got 40%. So we are basically saying when we work out the consolidated financial statement, the profit earned from the date of acquisition is also shared between the NCI and the parent. So let's say this is subsidiary. I'll call this subsidiary group retained. Subsidiary retained earning. I'll also now talk about I'll talk about the group retained earning as well. So here I'm talking about the subsidiary group earning. So we are saying this 8,000 has grown from the date. Remember what was there in existence will be eliminated in the pro forma consolidation journal. But from the date of acquisition to the beginning of the current year, there is 8,000. And remember, we do not take the retained earning of the subsidiary. So ideally, this would have been earned over time in the profit statement of profit, and therefore would have eliminated it. When we eliminate this, how do we eliminate this? By transferring this 8,000 to the group retained earning, which would have been 0.6 because it's a 60%. would have gone to the group retained earning. So we would have introduced the group retained earning would have grown by 4,800, and NCI again would have grown with 0.4. Let's say 0.4 of the 8,000. 0.4 times, I say times that, 3,200. That is the profit from the date of acquisition. So you can see this profit is still eliminated in full. And then 4,800 would have increased the group retained earning. Of course, the group retained earning has already something from the parent. Let me put it somewhere in B, because there is already something from the parent. Parent head group retained earning is also making other profit itself, so it will have grown elsewhere. So that is what basically this financial statement is saying, that from the date of acquisition to the beginning of the current year, the subsidiary has made 8,000, and that 8,000 is attributed 60% to the parent and 40% to the NCI. But the date of the 10% extra acquisition is on the 1st of July. Let me just reconfirm that from the previous slide. What's happening? Okay, not there. Here. Sorry, escape. What has happened? Let me do undo. So you see what we are saying? We have taken in terms of retained earning from the date of acquisition, which was 1st of July, to the 1st of January 2018. But this second interest of 10% was only acquired in between the year, and that year is 2018. So we've only taken the retained earning up to the beginning of the current year. But the acquisition of the 10% is happening in between the year, and they are acquiring 1,800. So let's recognize this acquisition. What will they do? That acquisition. They'll, of course, in their separate book, they are going to debit an investment of 1,800. And then credit a payable or cash, whatever it is. So you can see now, when we do our pro forma, the original one of 3,000 is eliminated in the pro forma. Then we now have a hanging 1,800. But however, during the year, if you look at this financial statement, I don't know what's happening. This financial statement are saying that during the year, profit for the year, assuming the profit is made evenly, half the year up to end of June is 3,000. So we can go and deal with the profit for half of the year. Profit for half of the year is how much? Is 3,000. So we can go and say and deal with another profit here in the subsidiary. We are saying 3,000 being half year profit. Again, this half year profit will be distributed 0.6 to the parent, because that is their share of that profit, and to the NCI, it is 0.4 times the 3.4. So ideally, we are adding these ones. These are the things we are adding here. So basically, and then we are eliminating that half a year profit. So we are basically saying we are redistributing the earnings of the subsidiary is still zero. Now what we are now left is only now at this point, 1st of July, 1 July, they have acquired, they are paid 1,800. But what has happened on 1st of July? They only acquired, they paid 1,800, and then who do they pay? Of course, what will they have done? They'll have debited their investment, and then they'll have credited what they call, well, they have credited their cash or something like that. But in doing consolidated financial statement, we are saying we will need to eliminate this 1,800 because we cannot have investment in the subsidiary. So how do we eliminate the 1,800? And that is where the crust of the matter is. So we are basically saying at this point now, at the point that they are acquiring, the NCI is 40%. This was original NCI at the date of acquisition. Then you have the profit that has been made from the date of acquisition. And then you have the profit that is being made for the first 6 months. So we are basically saying if you add the total there, we are saying NCI is at 1st of July, just at the beginning, before the acquisition of the 10% by the group is, and this represents 40%. Okay. That's basically what we are saying. And on the 1st of July 2018, NCI is worth 6,800, which represents 40%. And now the group want to acquire to reduce this by 10%. If this is 40%, what is 10%? 10% is what the group will reduce. So we want to eliminate this 1,800 vis-a-vis. Of course, it will be eliminated against the NCI reducing, and then the balance, we take it to the movement in reserve. So if we want to find out, what do we do? What is 10%? If 6,800 represent 40%, what is 10%? It's just dividing. If you divide this by 4, it gives you 10%. If you divide by 4, it gives you 1,700. So we are saying we are going to eliminate 1,700, being the 10%. Let me put it in red. That is what, by NCI, if we reduce NCI by 1,700, we have reduced it to 30%, from 40% to 30%. And then now, if we eliminate now here, we are going to credit the 1,800. But now there is a difference, if you can see that the group acquired interest or asset, net asset worth 1,700, but they have paid 1,800. So what effectively that means is that the group has lost 100. And therefore, the balancing figure here, we take it as a movement in reserve. We take it there 100. So that is what will happen. So when we prepare consolidated financial statement, we will basically show that NCI has moved on the 1st of August, 1st of July, from 6,800, you reduce by 1,700, that leaves it with 5,100, and the group has reduced by paying 1,800, but the asset equivalent is 1,700, and therefore there is a loss of 100, which is absorbed by the group. Then we now talk about the second half of the year. The second half of the year, again, the subsidiary make another 3,000. This 3,000 is to be distributed to the group. This time, the group is 0.7% because they acquired another 10%. So they will now get more than, what did I do? Is it 2,000? Yeah, I think so. So they'll get 10% more. You can see it is 10% more. And then the NCI now, which is here, we receive only 30%. It's no longer 40% in the second half of the year of the profit that was made in the second half of the year. Therefore, let me insert some numbers here so that we see this one well. So we are basically saying, what was the 900 there? Oh, the 900 should have come up there. Is what is their profit for the second part of the year. Okay, so we are now basically saying, now if we do the balancing figure, if you do the trial balance, to see how much NCI will be is basically adding that, less that, and seeing the balance carried forward. That will be the NCI. And you could do the way we used to do T accounts in first year. So it becomes 77. And then we just say the carrying forward is equal to that 77 minus this. That becomes the carrying amount at the end of 2018 in terms of the NCI. And then this one is, of course, eliminated in full. The ordinary share capital of the subsidiary will not appear anywhere. And let me just insert some cell just to avoid confusion. Yeah, so you can see the NCI now will be at the end of the year 2018, NCI will be 6,000. And this 6,000 represent 30%. If we go back to the financial statement and check what is the asset of NCI. So we could go and say, what is the net asset and what is 30%? We are saying net asset is equal to the equity, or the net asset are these 20,000. If you take 30%, because NCI is 30%, then you can see clearly the NCI is 6,000, which is what we have worked it out for there. That's what we have shown it to be. The NCI at the end of the year is 6,000. But remember that now if we work out what the group retained earning is, it will be the profit for the group plus all these post-acquisition earnings from the subsidiary, the proportionate share, less the 100 that was we call it a movement in reserve because they reduced. That is basically how the calculations happen. I've used a different format just to make you understand using T accounts that eventually when we are doing consolidation, the investment must be eliminated. The one which is there at the date of acquisition is eliminated in the pro forma consolidation journal that brings in NCI and goodwill. However, any subsequent, then we are basically saying it will need to be eliminated against a reduction of the proportionate share of net asset of NCI. If it was a gain, meaning the company would have paid, basically we are saying the company maybe would have paid, this is 5,700. So the whole amount is eliminated, but then we find that now they sold 10%, and therefore in the investment account, there is no enough. We can't, the amount showing on the carrying amount is much less. Let's see whether the other example will show us that. So ideally, that's how we handle movement in reserve. So you can see what basically I've done. I've done on the date of acquisition of 60%. We determined the NCI at inception was 24. The consideration was 39, the goodwill was 300. That's what we calculated. Then we said from the date of acquisition to the beginning of the current year, there was an increase of 8,000, which we shared 60% to the group and to the NCI 40% and the group 60%. Then at that date, then we are saying at the beginning of the year, or end of 2017, the NCI should have been 14,000 and the group retained earning would have increased by 4,800. Then we said for the 6 months to the new acquisition, there is a profit of 3,000, which is shared 40% to the NCI and 60% to the group. Then we find that NCI just before the second acquisition was 6,800. And of course, the post-acquisition earning was 6,600 to the group. Then they now acquired at 10%, which is the 1,800. That 1,800 means you are reducing NCI with an equivalent of the 10%, which was 1,700. That gives you a difference or a loss of 100. And that 100 is what we take to the group retained earning as an adjustment, is a loss, because basically they paid 1,800 for a net asset of 1,700. And therefore, at the end, at that time, immediately after the 10%, NCI is reduced to 30%, which is 5,100. Then there is profit now for the next 6 months. Those second 6 months, NCI now only shares 30% because they are the NCI, the group is 70%, and NCI is now 30%. And therefore, you can see at the end of the year now, NCI becomes 6,000, and the post-acquisition profit for the group is 8,700, but there is an adjustment over 100 loss that has to be reflected. Okay, so this is just using an analysis. If you look at it now, profit for the year, you can see the group made 17,000, both the parent is 11,000, the subsidiary is 6,000. Then we are saying attributable to owners. Basically, we are removing what was attributable to the non-controlling interest, which is 40% in the first half and 30% in the second half. If you look at it from our schedule, we are saying in the first half, NCI, we gave them 1,200, which was based on 40%. In the second half, we gave them 900 based on 30%. So the two added together is 2,100. That's why you see the profit that is attributable to NCI is 2,100 for the year. And then the rest is for the group. Okay, and that's how we make them in terms of the movement. You could show it. It's not clear from the accounting for equity whether that acquisition reserve, when you are changing, there's a movement in reserve between either up or down, either acquisition of extra, and whether it is shown separately or is offset against the retained earnings. Some companies have opted to show it separately, but most companies have put it under retained earning. Being there, they have netted it off over the post-acquisition earning of the subsidiary, which of course closes into the group retained earning. But in this case, I've shown it separately so that we can see where it arises. It's because we acquired a 10% interest from NCI, which was worth 1,700 equivalent of net asset, but we paid more than that, and therefore incurred a loss. If we had paid, let's say, 1,600, then we would have recognized a gain of 100. And you can see now we are putting it as under other reserve, but we could easily offset it under the group retained earning, provided there is disclosure. In the note, we can show the breakdown that acquisition reserve is netted off there. Okay. Okay, this is an example which is simpler. I think I will let you do it alone. It's much easier than the one we have done, but it's just like the first one we did. It's what I've been using all this year. Just go through it, make sure you understand it. And then the next thing I want you to do is to go and try and look at, is it question 1 of test 3 or test 2 of last year, which is on step acquisition. Make sure you understand and you can follow the steps that are necessary for doing a step acquisition. Of course, all you need to do is to understand what we have said in terms of what is the reserve, what is affecting the investment, and where are the offset. The offset are always in NCI, and calculating the equivalent of the increase or reduction in NCI become the critical factor in passing the correct entry. Any question?